you eating crunchy?
So, I'm Malcolm Wong. For those of you who don't know me, I convene the DDTB Investment Committee, and we've got on our committee, we've got Stephen Grant, I'm sure everyone knows, and Susie Johnson. And also we're ably assisted by Fiona Gray, an accountant from the diocese, so she provides all our administrative support, for which we can't do without. And we have our investment advisors from Craig's Investment Partners, Greg Easton and John Blaikie. So, kia ora koutou, welcome, no mai, haere mai, everyone. Thought we just give an introduction in terms of what we do, for those of you who don't know the works of the Trust Board Investment Committee. It's a subcommittee of the Trust Board, and we're charged with helping to manage and govern the investments of the parishes and also of the special bequests. So the diocese doesn't have investments per se of its own. We, as of the investment committee, govern in terms of and manage the investment on behalf of you, the diocesan members, and also for special bequests that we might have as well for special purpose funds. I think that's a reasonable summation, isn't it, Stephen, in terms of what we do? You're on mute, so you might want to unmute if you want to have a contribution there. So
I can confirm that that's correct, Malcolm.
Thanks very much. It's nice to have confirmation from my committee that I'm not actually just spouting something which is an untruth, or was it they call it false news, which they have these days, to coin a popular saying. So to use an acronym, we use a SIPO, a Statement of Investment Policies and Objectives, to govern what we do in terms of how, what, and why, how we invest, what we invest in, and why we do it. And as I said, we are there in our fiduciary capacity to manage and to invest the funds for you as parishioners, and also for those special funds. We do have two funds which we separate out. One's a growth fund and one's an income fund, and I'll get Greg and John to explain about those later as we go on. I won't say too much because I think the most important people to speak here are Greg and John, and also if you have any questions as well, if you could raise your hands at any time, hopefully I will be able to spot those and bring you into the conversation. So I just also want to touch on a popular notion of impact investing, and you've probably heard about that term bandied around. I don't want to talk too much about that because it's still a little bit, I believe, in its infancy. It's to look at investments which may have a bit of a social impact as well, but also be able to return an investment return for the investor. It's a slight sort of sometimes they can be in conflict of each other, so it's one's obviously for the social good in terms of impact investing. The other one is to have actually something appropriate, which also enables us to get a reasonable return. So I don't know if Greg or John want to talk anything more about those, but they're few and far between at the moment, as from my experience. So we have not delved into that area at the moment for our funds. So having said that, I just will now turn over to Greg and John just to go through a bit of what we call Investing 101, perhaps talk about the difference between growth funds, what that's there for, and our income funds. So we have most of our funds at the moment in the income fund, and also we have a growth fund as well, which has a lesser amount in it. I can go through the actual figures later on, but I want to turn over now to Greg and John. So Greg, he's a lead advisor from Craig's, been with us for a number of years.
Thanks, Malcolm. Yeah, look, I'll talk for 10 to 15 minutes or so, I guess, just going over briefly types of investments and why we invest in certain things we do, and particularly on the growth fund, because that's probably a little harder to understand. And the income fund, it's all in the name really, isn't it? So I'll try sharing my screen. Let me know if this works. Right. Can anyone see the title page there?
Yep.
Is that a no?
Yeah,
No,
that's all good.
Oh, sorry. Okay. Right, so as Malcolm kindly pointed out, my name is Greg Easton, and I'm an investment advisor at Craig's Investment Partners. I've worked here alongside the Dunedin Diocesan Trust Board for the last 21 years, and I'm hoping to for another 20 or so. So I'll introduce you to the types of investments make, and as I said, particularly those of the Growth Fund. If I skip over anything too quickly or use acronyms or jargon, I'm sure John will trip me up and slow me down. Thank you, John. So, and yeah, that's John Blaikie, who's my partner of the last, I was going to say 8 years. Is that right? That is right.
Yeah,
so,
that sounds about right. Nice to meet everyone.
All right, so let's get into it. So you're not going to get away with no marketing spiel at all. Craig's Investment Partners celebrated 40 years in business last year, having been founded by Neil Craig and Whakatane back in 1984. We are 50-50 owned by over 350 staff, and as of the 1st of May this year, TA Associates, which is a global private equity firm which specialises in investing in financial services businesses. We have over 65,000 clients, over 650 staff in over 20 locations. At the moment, as of today, we are 194 investment advisors, advising on funds in excess of $30 billion. We have 22 analysts, which makes it one of the largest in-house research teams in the country. So John and I may look like we know what we're talking about, but we actually do have 22 people at least that do know what they're talking about. So why do financial markets exist? It's quite a fundamental concept to grasp really when it comes to investment. I mean, investors are driven by the need to allocate their funds in a way that generates them a return. And in turn, companies need capital to grow their business and undertake the activities they wish to. And in return, they'll offer interest or dividends, which creates a nice symbiotic relationship. So understanding that dynamic is quite crucial for anyone looking to navigate the investment landscape effectively. So how do we marry up those investors in the companies? Well, generally, we do it through stock exchanges. New Zealand, that's the NZX, of course. Australia, the ASX, London Stock Exchange, New York Stock Exchange, all names that we'll be familiar with. And why use a stock exchange? Many reasons. First, it provides a platform for those investors and seekers of capital to exchange. It is a regulated platform, so everything's done above board and no one's taken advantage of or ripped off. It provides a high level of liquidity, so any day you can log on and see who's got what for sale and who wants to buy what and how much and at what price. So there's a very high level of price discovery when it comes to valuation of companies, and yeah, so probably a bit more transparent than the old real estate market. Well, so we often refer to the stock markets by their index, which is usually a certain number of the companies on that exchange. And then in New Zealand, it's obviously the NZX 50. So that happens to be the 50 largest listed companies in New Zealand. And in New York, it's a massive market, so they have a number of indices. And you'll be familiar with the Dow Jones, which is actually a small index of only 30 companies. The S&P 500, which is the 500 largest companies. And the NASDAQ is another one, which is 100 companies, predominantly technology and healthcare focused. So those are share markets. So there's a range of what we call asset classes that we can invest in. I'm going to talk a lot about shares tonight, but of course we have cash, we have what we call fixed income, which is bonds and term deposits. A bond is essentially like a tradable term deposit. We split property out as a separate asset class, and that can be invested in many ways, either directly or through listed vehicles. And we tend to treat New Zealand shares, Australian shares, and global shares all separately. Now, all of these different asset classes have produced different returns over the years, and also been or shown to have a lot more risk or less risk. Cash obviously is the least risky asset, as indicated by this illustration, and you could really throw any of those groups of shares at the top end. This is purely for illustrative purposes to give you an idea. So what do we need to consider when we look to buy an investment or invest money? We need to think about how long we're going to have this investment in place. In the trust board's case, it's in perpetuity really, so we've got quite a bit of time on our hands. We need to figure out if we need to generate an income off that investment. Clearly, the income fund does need to generate a lot of income, so that's a very high priority for that fund. And we also need to consider the liquidity. Should we need a big lump of capital from the fund in a hurry, how quickly can we get it? We need to think about how safe our investments are, and particularly on the fixed income side, where you're essentially lending money to a company or an organisation. So are they going to pay you back? Certainly hope so. Growth is an important aspect, and clearly for the growth fund, that's all we're after. But everybody needs to consider growth when making an investment decision, because we have to combat that inflation, which is not going anywhere. Tax is always a consideration. It's never a driving factor for us, and for the church, obviously, it's not such a big deal under current legislation. So Craig's investment philosophy is built on 4 basic tenets. We keep things at a high level of quality. We have inflation at front of mind, so we're trying to generate income today, but we're also looking for income growth so that in years to come we maintain our purchasing power. We take a conservative approach to risk management, and we're always looking to use the only free lunch in investment to manage that risk, and that is diversification. So we will diversify, and you'll hear that word more than once tonight. So risk comes in all shapes and sizes, and we're seeing a lot of it at the moment, particularly in areas of political risk, with perhaps a volatile president in place in the United States. The geopolitical tensions, obviously, we've got Iran and Israel hopefully ceasing their tensions. The ongoing Israel and Gaza confrontation, Ukraine and Russia. I mean, not that long ago, India and Pakistan had a go at each other as well. There's a lot going on in the world. In New Zealand, over the last few years, we've obviously had some severe weather events that have caused a bit of turmoil. The fairly major earthquake in Christchurch back in 2011, and Mycoplasma bovis. I mean, that was we really got away with one there. That could have been absolutely catastrophic to our little economy. But the short story there is that there's always something to worry about. So how do we decide what to invest in the way of shares? Well, there's two styles or two ways that we make a return out of investing in shares. One is dividends, which is essentially a share of the profits that the company makes. And the other is capital growth, so an appreciation of the share price, which is an appreciation of the value of the company. So, and why is that growth so important? This is a great example here. So we're going back to 1967. I think that's maybe because that's when decimal currency was introduced. So if you had $1,000 in 1967 and put it under the mattress, you could dig it out today and it would still be $1,000, right? Had you put that in term deposits and reinvested all the interest and everything over those almost 60 years, you'd now have $15,238, which sounds pretty good. However, had you been able to invest in inflation, or at least if you wanted to have the same spending power of $1,967 today, you'd need to have $23,496. So the term deposits have not kept pace with inflation. Essentially, you've gone backwards. Had you invested that $1,000 in the New Zealand share market, and this is just using the broad market index return as a figure, you'd have $178,498 today. And that's quite remarkable, especially when you think about all of the major events that put people off investing in share markets, such as the global financial crisis, the 1987 crash, the 97 Asian crisis, 1973 oil shock. All of those things have happened since 1967, but we've still grown $1,000 into almost $180,000 in that time. So another way of looking at the importance of growth that we get from shares is the income growth or dividend growth. A well-performed company should produce profits that grow year on year, and usually that enables them to pay a slightly higher dividend year on year. So in this example on screen, we have a portfolio of 10 New Zealand companies bought in 2003. So we need those 10 companies to still be around. So just to let you know, those 10 are Auckland Airport, Contact, EBOS, Fisher & Paykel Healthcare, Fletcher Building, Infratil, Main Freight, Port of Tauranga, Ryman, and The Warehouse. So you had $100,000 spread across those companies evenly. Back in 2003, you earned dividends of $7,330, which in itself is a nice return. It's 7.3% return. Term deposits would have earned you $5,247 in the same year. Fast forward 20 years, holding those same 10 stocks, they will now be earning you $30,002 a year, while that term deposit will still earn you $5,200. This data is a little bit old, so you won't actually get $5,200 anymore. But anyway, the income growth there has been quite exceptional. It's grown over 4 times inside 20 years. Now, obviously, not all of those companies that I mentioned have performed particularly well. You may be aware companies such as Ryman Healthcare and The Warehouse have done the exact opposite and are both trading near all-time lows, which is why we spread it around, because not everything behaves the same. So we can diversify by individual company, as touched on there, but we can also diversify by asset class, which is a big part of portfolio investment. So we can invest in shares and fixed income, or we can even break out that share investment into different industry sectors and beyond that, geographies. So there's no way we would want to have all of our investments in our own little island nation, which is prone to economic shock and natural disasters. So we've got to have some investment away from what we know best. So an example of a portfolio that we would use for an income-focused investor would look something like this, and it's not too dissimilar to the targets set out in the income fund SIPO either. But roughly 55% in what we call income investments, and those are those term deposits and bonds, the interest-bearing style investments, and 45% in shares. And the shares we split up between New Zealand, Australia, and the rest of the world, and again we treat property slightly separately. Why do we spread it across these different asset sectors? Well, because every dog has its day. So in this table, the dark green cells shows the lowest performing asset class of that particular year, and the light green cells the best. So in 2023, which is the line fourth from the bottom, I doubt you can read it, but in 2023, the very best performer were international shares, which were up 23.4% that year. And the worst performing asset class was New Zealand house prices, which were actually down 0.7%, which is amazing because New Zealand house prices were the best performer in 2020, just 3 years earlier, with a 19.3% return. So what you'll see also there, the third column from the right, that's our research team's balanced portfolio. And you'll note that there are no green cells in that column because that balanced portfolio has a little bit of everything. So it'll never be the best, it'll never be the worst. Yet over the period we're looking at here, which is around 20 years, it's managed to average a 7.2% return. So yeah, diversify. And here's just another way of looking at that. Pretty much every asset class will go up over time. That top line is actually New Zealand shares. It's been one of the best performing asset classes over the last 25 years. Maybe not so much the last 5 years, but last 25. And down the bottom, we've got the very low volatility things like the yellow line is inflation and the bluish green line is wholesale interest rates. So that's your money in the bank essentially. So you see they don't go up and down so much, but they're pretty low. The highest returning assets go up and down a lot. It can be a rocky ride. So you've really got to stay in for the long haul and ride out those waves. So in terms of investment, there's a few do's and don'ts. So do be careful. always think before you jump. Have realistic returns. Don't expect the market to return 10% every year. It just simply won't happen. Spread it around, diversify. Make sure you're generating some income in your portfolio, be it a small allocation to those income assets or a good stash of shares that pay decent dividends. And take a disciplined approach. So come up with a strategy, monitor your portfolio, and if it's not in line with your strategy anymore, bring it back in line, and do that regularly, and reassess the strategy as well. And what you don't want to do is ignore inflation. Don't rely on market forecasts. Believe it or not, no one actually knows what's going to happen. Don't buy and forget. That's what I come back to, monitoring your investment. Things do change at an individual company level, and obviously macroeconomically, things are always changing. If something sounds too good to be true, it almost certainly is. So please at least ask someone before saying yes to that smooth talking American on the phone. And don't invest in anything you don't understand or your advisor doesn't understand. You are allowed to delegate those responsibilities. So now I'm just going to talk a little bit about the growth fund. So this is a chart of the growth fund's performance since 2000, which is as far back as the data goes. Since 2012, the fund has easily outpaced inflation, which is that green line down the bottom. And over the last 5 years, we've enjoyed above average returns. So that black line represents the average return, essentially, since 2000 to today. So that's a dynamic line that will change. But yeah, things have gone well recently. So I think that the current unit price is something like $6.60. and you're looking back there in 2000, it was just a bit over $1. So how do we spread around the investments for the growth fund? Well, currently we are invested almost 100% in growth assets, shares, and almost half of that is in global equities. So we're looking to reduce that as part of our disciplined approach to the portfolio management. And what sort of shares? Well, names most of you will be familiar with, I'd suggest. This is just a selection of the companies that the fund invests in directly. So you'll be familiar with Mainfreight and Contact, certainly is New Zealand brands, Woolworths and ANZ. You don't get much bigger brand than that in Australia. And global brands like Visa and Nestle and Google, pretty hard not to know. So I think it's fair to say that we all understand what they are. And the income fund, completely different. I mean, it only exists for one reason really, and that's to generate an income that is a bit better than having your money in the bank. I mean, its official target is to achieve a gross income of 2% over the official cash rate. Official cash rate is currently 3.25%, so it's aiming to go 5.25, but it's probably not that easy in the current environment. And obviously, they're looking to maintain the capital base that's there for generations to come, and but more importantly, provide that income stream so the investors can go about their business. And how do we spread that income fund money around? Well, currently like this. So a really good chunk of it is in that interest-bearing type investment. So around about 47%, plus the mortgages 61%. So yeah, it's a fairly conservatively managed fund. You see it has quite a large allocation to New Zealand shares, and that's because New Zealand shares typically pay higher dividends than shares around the rest of the world. And as mentioned, we're just trying to generate an income in this fund, so that's why we're there. I'm sure you'll have plenty of questions about the details of the funds, which I will pass over to Malcolm for. But I'll try my best to answer anything else you have.
Thanks very much, Greg. I was right in terms of your title. It's Investment 101. I just hope that everyone got something out of that so that they can go away a little bit more informed. John, I didn't know whether you had anything else to add to Greg's before I sort of summarize where we're at the moment.
No, I mean, Greg, yeah, he's, as always, covered off pretty well. I mean, I guess sort of three messages from me really is, ensuring that what you're investing in or the asset allocation, as Greg talked to, is appropriate for the level of risk you're prepared to take. So that's really, really important. And one of those determinants is around the time horizon. So you've got to be really cognizant of what that is, and then make the decisions based on that. And we often talk about a phrase, it's time in the market, not trying to time the market. That's a really important thing as well. So you need to be really clear about the level of risk that you're prepared to take on. And as Greg again talked about numerous times, it's around not having all your eggs in one basket, spread it around and diversify.
Thanks, John. Just before I throw it open to questions, just want to make a few points. The whole tonight's sort of session was down for an hour and a half. We probably won't go through that period of time because after an hour and a half, I think everyone will be a bit sort of head will be a bit spinning. So I'll probably round about just over about an hour or so, if that's all right with everyone. Anyway, if it's more interest, we can still keep going for a bit over the hour. But just in terms of some of Greg's slides there, the what factors that you had to consider in terms of risk and growth and income, etc. That slide, I think right at the beginning, what to consider, that one there, timeline, income, liquidity, those are all the things that we can set for tax in our case that we consider in our statement of investment policies and objectives. All those things are there that we put into our what we call the SIPO to ensure that we manage and govern the investment and of these of your funds properly. We review that SIPO annually, and as part of that investment policies and objectives, we have also what we call a strategic asset allocation, which is what type of investments we're looking at in terms of fixed interests, the allocation between those categories of fixed interest, shares, property, etc. So make sure that we're getting the right balance for the fund that we want to invest in. So the two major ones that we've got are the growth fund and the income fund. And Greg's been through with you in terms of the philosophies behind why you would invest in those. I just want to challenge and perhaps put this point across to parishioner vestries. Your own time may be a short time frame on vestry, but I challenge you, it's not your time frame that you're on the vestry, it's the parish's time frame in terms of investment that you probably need to consider, in terms of if you have funds which you don't need and you want to grow those, then obviously the fund to put in is the growth fund, because over time you'll see there that long term of almost 60 years, a growth fund achieves quite a good exceptional return over time. I mean, the time frame I think that we have a minimum in terms for the growth fund, I think it's about 5 years, I think. Is that right, Greg, in terms of the time frame, the minimum time frame for which to invest in the growth fund?
No, I don't know. Sorry, Malcolm.
I think that we have a sort of I thought we had a sort of a general sort of, in terms of you don't really want to be taking money out too early, because it's in these things in the growth fund, it's a matter of being, as John said, time in the market, which gives you your growth. It doesn't mean to say that you can't take profits as you go, but it's not designed to take monthly withdrawals out of the fund.
That gives me an opportunity to drop another cliche in there. You don't go broke taking profits. You really wouldn't want to invest in any sort of growth fund or any sort of share investment for any time less than 5 years, really. So you really want to be able to be without that money for at least 5 years before you could comfortably make that sort of investment. That's what we always say to individual clients as well.
Yeah. So as we say, 5 to 7 years in the growth fund. The fund itself has got about $1.5 million of the growth fund. We believe it perhaps is a bit underutilized at the moment. And most of it, as Greg says, is invested in shares, because that's the type of it's a long-term fund in respect of almost in perpetuity. You need to think about it. But for example, the value of those units in 2020 was $4.83, and now at $6.63 last month. So it's quite it's been quite a good earner in that respect. And as I say, it doesn't mean to say you can't take your profits a certain amount if you want to as you go along. The other one is the income fund. The income fund's got about $38 million in it. Most of it, as Greg has shown, is in fixed interest, and so we manage that accordingly. We do, and the do's and don'ts, we look at those for you as part of our management process in terms of managing those funds. We do that. We meet monthly. So those do's and don'ts are some of the things that we look at in terms of managing the funds on your behalf. We, as part of the SIPO, the Statement of Investment Policies and Objectives, we do have an ethical investment policy as well. So it's all transparent, and it includes sustainable investment aspect to it as well. In fact, we're just looking at a sustainable fund as well at the moment, aren't we, Greg, in terms of the growth fund?
Yeah. And it's a fund of sustainability leaders in Australia that we're looking at, and it rules out a lot of businesses for obvious reasons, such as fossil fuel companies. But yeah, they've still managed to find 80 companies in Australia that are making positive, sustainable moves. And so, yeah, you can feel good about investment in a fund like that.
So those are some of the things that we consider, and that's just some of the work that we do every month. For those who don't know me, I'm a chartered accountant. I've been public practice for about 40 years, just recently semi-retired. I was on the Community Trust of Otago in terms of their investment and risk committee as well. And I chair the Audit and Risk Committee at the university. So we're quite used to, both Stephen and Susie and I are quite used to these terms of SIPOs and strategic asset allocation, and that's what we try to do on your behalf, is to look after these funds and have a process in which we can do that under. We also govern by the regulations of the diocese as well, in terms of processes as well that we go through. So that's really a bit of what we do, and so we're not trying to make sure that we're not just something going on in the background, and that you understand what we do, and trying to manage your investments for you. So with that, if you've got any questions, if you can just raise your hands or shout out or something like that, because I can't quite see everyone. So Heidi, you've got something there that's come up.
I always assumed that you make the decision of where to put our funds. So our St. John's, we've got, I think it's 8 accounts, but when we get the statements, it just says trust accounts. So are they all in income funds?
Well,
because I mean,
you decide where those money go. So we only invest in each of either the growth fund or the income fund, depending on, we don't make the decision of where to put the funds in terms of which fund they go into. It's your money that we try to manage on your behalf. As to but the decision on which fund they go into is entirely up to you. Heidi, is that right, Fiona? That would be right. Are you there? Or Stephen will be able to answer that. I think that's...
Stephen is muted. So
Stephen, you have to unmute yourself.
Can I comment on that? Giving you examples of two diocesan institutions with which I'm associated with, which have invested in the growth fund and the income fund. Or the first one that I would quote is the Leslie Groves Society, which operates the home and hospital at Wackery Road and Sheen Street. And Leslie Groves has regular building projects for which it gathers up funds and then spends them on the project. So Leslie Groves has over time been a regular contributor to the income fund because its time horizon for the use of the funds is less than 5 years, generally about 3 years. Another organisation which I'm have an involvement with is the Cathedral Foundation, which looks after a fund of money which is to be used for the maintaining the fabric of the cathedral. But there, a relatively modest sum was invested in the growth fund. The intention being that it was unlikely to be required within a 5-year time horizon. And in fact, the most recent call on funds from the growth fund for the Cathedral Foundation was after it had been there for in excess of 15 years. So it had enjoyed the spectacular returns that Greg mentioned can be obtained through the growth fund if you are minded to leave the funds there for a long period of time. I don't know whether that's helpful.
But Stephen, sorry, Heidi, Stephen, it was the cathedrals and Leslie Groves' decision as to which fund they go into, isn't it?
Absolutely. The Leslie Groves made the decision to invest in the income fund, and similarly, the trustees of the Cathedral Foundation chose the growth fund for the bulk of its funds, but it also had some funds in the income fund as well.
So our task is that once they're in those funds, is then we manage the individual investments that make up that fund as to what we call the strategic asset allocation. So Heidi, so it's entirely up to your parish as to which fund they go into.
I understand that. Sorry, what I was thinking, we've got 8 different accounts, and some stuff is like, say, for roof repair and stuff that we save for. But then we have a general reserve that's more than what we would use in 5 years. I mean, that is the money that the people who came before us looked well after. Would it be possible to put part of, or I'm just asking because I must go back and advise Vestry to put part of that. What if we know that, I mean, that money is not going to be
required?
Do we shift it to a growth fund?
Well, that's what we're trying to say, I think, tonight, is to let you know that we've got these 2 types of funds, and it really depends on individual parishes as to, as you say, that if you don't need these funds, you don't have a call on the income, and that they are not going to be used for at least 5 years, then the opportunity is to utilize the growth fund, because that's what it's there for. In the past, I mean, we did have quite an amount in the growth fund at St John's, but we redeveloped the property. I was the treasurer at that time, and I spent most of those. But that was
no, that's what I was looking at these statements, and I wasn't sure because I know who were treasurer before me, so I just
that was what the funds were there for, and so we were able to have Heidi to do that.
Yeah.
To answer that, Heidi, all your funds are in the income fund at the moment.
Thank you very much.
Kit,
Thank you much.
That's right, Heidi. Thanks, Kit. You've had a question. You've been
patiently
waiting there.
No worries. Regarding the growth fund, and I note recommend a minimum of 5 years, and I think 10 years has been the sort of preferred period of time. In the event that a parish's circumstances change, is it relatively straightforward and over a short period of time that one can actually break into that growth fund?
You can. I think there's a time period of notice required. Fiona, you'll be able to.
Yeah, there's a 3 month. There's a 3 month notice period and a bit of a calculation that's involved with taking the money out. And that's mainly because we may have to find cash to actually pay you out. So we need time to sell shares or sell some of the equities or to do that. The rules, there are a set of rules around it, but 3 months is the main notice period.
We can provide everyone a copy of those notices and things if you'd like.
Yeah. Perhaps a sort of indirect question relating to that. If one does invest a proportion of one's investments in the growth fund, and it's that the income balance of the income invested proves to be insufficient to meet a parish's needs, is it actually beneficial to eat into the growth fund, or in fact use partial capital and interest from the income fund? Is there some sort of identifiable way? I know it's a rather unfair question.
How long's a piece of string, Kit?
Yeah.
I don't know if Greg or John have any comments related to that. It's if we had a crystal ball, Kit, I'd make a fortune.
Well, perhaps this highlights one of the features of the income fund, in that you maintain reserves so that you are able to boost the level of income in tight times, whereas no bank deposit will ever do that for you.
Sometimes if there's profits to be made, every so often, as I said, in the growth fund, it doesn't stop you from making call into the growth fund every so often to take those profits if you think, and then put them into the income fund. But it's not designed to make wholesale quarterly withdrawals or monthly withdrawals, Kit.
Okay, just a third question, and then I'll be quiet. I'm just curious as to whether or not the interface between Craig's and the trust board, does it work that Craig's, Greg, you go with proposals to purchase or to sell to the trust board, and they make the call, or do you simply, as the trust board, rely on the work of Craig's? I'm curious.
We execute the transactions decided by the investment committee. Well, decided by the trust board, recommended by the investment committee, I believe. But yeah, there's kind of a circular reference, because the investment committee comes to us for recommendations when they feel it required.
Yeah, so Kit, it's not carte blanche. Greg and John come to the investment committee with recommendations, and we have the final say as to whether or not we take up those recommendations. In fact, we were just having a discussion just this week or last week about some rebalancing of our growth fund, because we have certain percentages and benchmarks for which we want what we call asset allocations, how much we put in shares, and in that also how much we put in overseas shares, New Zealand shares, Australian shares. So we wanted to take some of those profits in the growth fund at this stage and rebalance between the categories, because one was getting out of balance, which means that the values of those shares have gone up. So we wanted to take even within the growth fund, we want to take some of those profits and rebalance it into other assets. So we were looking at some sustainable funds, and Greg had given us 3, so we had to choose which ones, whether we spread amongst the 3 or we chose one particular one. In the end, we've gone to one particular one because it was had we thought a better reputation in terms of its sustainable policies and procedures, and it was a big enough fund as well. It's called its acronym is called FAIR, I think, isn't it? FAIR, not FEAR. And so yeah, so we do have active dialogue with our investment advisors, and not always looking at the options or that they may recommend as well. So
can I just add to that, Malcolm, that the investment committee meets with John and or Greg each month on the generally the second Thursday in the month. So
yeah,
we're looking at it on at least a monthly basis.
Yeah, and if there's something comes up as well in between times, Greg and John will email us directly. The wonders of modern science these days. Kit, sorry, Anne, you've been waiting there as well.
Thanks for that. I'm just not sure, and I think Fiona can probably tell me very quickly. I think that all our investments from Holy Trinity Gore are actually income accounts. Is that correct, Fiona?
Yes, I'm pretty sure they are.
So if we chose to shift some of them to growth, that would mean then we would not get any income, any of the interest. Is that correct?
That's right. You would have less interest paid out to you or accumulated on those funds. Yep.
Right. Thank you. That's what I thought was the case. Thank you.
Yep, that's right. We've got some of them. That's something. Oamaru, is it? Linda Taylor.
As a Dawson Council, I think they have a say in.
Linda, are you there?
Yes,
Keith,
I'm here.
Oh, sorry,
Keith,
Anne, did you have something else?
Yeah, just Keith wanted to ask something.
Oh, Keith,
Yep.
okay, sorry.
Yeah, so the Dawson Council believe they have some say in some of the decision making if funds are needed for a particular project. Now, is that correct?
That's more about if you're perhaps looking at proceeds from the sale of property, something like that. That would need DIO council. But the
yes.
funds would be invested in one of your pots.
So where those funds were to be used for a particular project in the parish, does the Diocesan Council have a part in the decision making, in the sense that the Diocesan Council has to approve the project?
It's probably slightly outside what we're doing tonight, Fiona.
Yes.
Would that be something that you want to take offline with Keith?
Yeah, possibly. Yeah.
I didn't have a particular example. I just wanted to know.
Yeah, it's probably a bit outside what we're talking about investment strategies. So perhaps Keith and Fiona could perhaps take that offline.
Yep.
Yeah, I think you'll find that's governed by Statute 3. Now, my question was probably similar to Anne's question about how we tell which type of funds we've got in our parish, because it doesn't say on our statements.
No, I can tell you that almost everyone, there's probably only about 3 parishes that have money in the growth fund at the moment. So you can assume at the moment that they're all in the income fund.
Yes, we've got $38 million invested in the income fund and about 1.5 million invested in the growth fund. So is there any way of telling, Fiona, for people to on their statements to know that it's actually in the?
Well, the statements they get, the quarterly statements I send out are from the income fund, and they wouldn't
Right.
get interest from the growth fund because if it only,
Right.
they'd only get paid out if they'd only
Right.
get that when they sold out.
Sold. So any statements that you get, quarterly statements, you can be sure that it's in the income fund, as Fiona said, because that's the interest, and you don't get interest in the growth fund. The only way that you can get income out of the growth fund is to realise some of the units. Now, you might think that actually selling some units is drawing down the capital. In fact, in investment terms, in these growth funds, the only way that you get a return on investments is selling down some of the units, because that if the units have gone up in value, you're actually taking out some of your gains or your income from the original investment. I think so. So increase in value of those units is actually in investment terms, the income in the growth fund. Is that right, Greg?
So if
No.
somebody has left funds,
Sorry,
oh, sorry,
lost my point. You carry on.
if somebody's left funds and specified that the interest, that only the interest can be used, that means we have to put it in the income fund, does it? Or
Generally speaking, yes, that's where the income, that's where the funds will be invested.
That's only if you wanted to use the interest, though. Otherwise, you
Yes.
could put the capital part, the bulk part, into the growth fund, but you just wouldn't be able to get
No,
any
but if
interest
the
on it.
fund, if the bequest or the fund says that the capital had to be maintained, and only the income or the interest is to be used, then I guess it would go into the income fund. It depends, though, I guess. As I said, growth funds, if you invested at $4.83, then they're worth $6.63, and you had the original amount of units in there, then the difference between $6.63 and the $4.83 is actually income. In terms of, because it's the growth in the value of those shares. So I don't know whether you think that that's income in your terms, or capital. But
yeah, no, that would make sense. That way you just explained it, that you could draw down so long as you left the original capital there, sort of thing.
yeah, that's right. The only problem is, of course, income fund. That's whether or not you have to. If the original amount says, the original bequest or the term of that trust fund says you've got to take into account inflation, then that's a different matter altogether.
Right. Now,
Because
what was? So I had another question, but I've forgotten. I'll come back. I'll put my hand up later.
okay, thanks. Is there any other comments, Greg, and you'd like to make in terms of increase in value in terms of those of the growth fund? Then that's just another form of income, really, isn't it?
Do you think,
Yeah.
Greg, you could explain that you buy units in the growth fund? Would that make more sense to people?
Yeah, I think, there's a lot of terminologies being thrown around which are more or less meaning the same thing. I guess I touched on return coming in two forms from investment in shares, and that being dividends, which is income, and capital gains, growth, an increase in value. So with the growth fund, it's priced every month, so it has a unit price. 100,000 units worth $5 each at the end of the month, and then they might be worth $5.10 the next month, for example. And in that example where you're looking at using only I think you said interest was the term you used, but perhaps if you termed it as the returns, but maintaining your capital base, well, then you can take 10 cents out after that month. And And also, you know, the income fund doesn't necessarily pay interest either, does it? It's a total return. It's come from interest, dividends, and in those lean times, it's come from capital gains as well, which have been taken and banked away for those rainy days. So yeah.
So perhaps it's the best to think about in terms of returns that you'd make rather than just interest and dividends. Interest and dividends is what we are used to in terms of getting a tangible benefit on the return, because that's what we have to put in our tax returns, for example. So the IRD calls that income. But when you're looking at investment returns encompasses, as Greg says, not only just the interest and dividends that you might get, but also the growth and the value of those investments. So so it's a different concept, I know, and it's hard to get around sometimes because people don't like realizing investments as part of their returns. But that's what's done all the time, and that's what happens in, for example, the Community Trust of Otago, because it invests as an in perpetuity fund, and to get some of its returns, it's those returns encompass realized and unrealized gains as well. So Linda, did you have Linda?
Yes, a question. If a parish would like to reevaluate all the funds that they've got and how they're invested, is it possible to get like a professional or to get someone to work with them to say this fund that you're currently investing would be better placed elsewhere? We've just followed along for so many years and with the funds we've got, and this presentation, which I found really interesting, thank you, has made me think, should we actually sit down and have a good review of our funds and how we could better use them? But how could we get some professional sort of help?
Well, I don't know, Greg and John, I don't know whether you're wanting to, you'll be able to help out in those. I mean, I understand that everyone asks vestry and volunteers quite a lot, and you've got to have expected to have all these different skills such as financial acumen, investment knowledge, and all those types of things, and understand what it means by a diversified portfolio and growth and in perpetuity funds and all those types of things. I don't know if Greg or John would like to go out and have a chat with individual parishes.
I think it's something the parishes should look at, you know, at least annually, isn't it? And I'm sure I can speak for John saying he'd be more than happy to go and visit once a year. As would I, especially to some more beautiful parts of Otago and Southland that I don't get too often enough.
You might get a cup of tea, John.
Exactly. And I was going to say, one of the things that we do work through, which, you know, possibly we could send a link to or a document to, is a risk tolerance questionnaire. And look, it's actually, you know, it's sort of 11 questions, and you can multi-choice as well, so no right or wrong answer. And that does give you a bit of an understanding. You work through that as to what type of investor Parish is. So, I mean, that's one of the first things that we go through with investors, to, as I say, to get a sort of a guide of what we're kind of wanting, or the investors wanting to invest in. So, you know, that could be quite a useful exercise to go through anyway. And yeah, look, happy to sit down and work through that, no problem at all.
Would that be useful, Linda, if they could send out that questionnaire to start with?
Yes, definitely. Thank you. I'd appreciate that. And
then you could have a further discussion with John or Greg on that basis as well, as to whether or not, for example, you have got funds which are really sort of not required, and you might want to put them into the growth fund, for example, or whether or not the growth fund's where you want to be, or the income fund. But they do have reasonable returns at the moment, and they have been giving reasonable returns to parishes over the years, I understand. But anyway, so that might be something to help you with. Now, have we got? We've got Mahino.
Just Gore would be interested, John, too, please, if you were sending that out to them, send to Gore as well.
Yeah, no problem.
Anyone who would want
list.
that, perhaps let John. Have they got contact details for you, or Greg, or do we go through? I want to trouble
you could send it to me, and I could pass it on to the people in particular that have been at this seminar.
Yeah,
or to
I'll
the
send you a
treasurer.
copy. I can send you a copy of our slides for what they're worth, and a link to our online questionnaire that you can forward around everybody.
Thanks.
Right. Okay. Well, we've got someone from Mahino, is what?
Yep.
Right?
That's right. So one question is the funds in the income fund rather than the growth fund. Our parish has a number of different investments in there, but if all the things in the income fund have the same interest rate, is that right?
Correct.
Yeah.
Yep.
It's one big fund.
Yeah. No, that's what I thought. Yeah. And my second question was, you were talking about how the income fund has quarterly statements and the growth fund doesn't have statements, but wouldn't you need at least an annual statement for your annual accounts so that you can say what your assets are?
Yes. I'd have to give you the value, the market value at the end of the year for you to put into your accounts.
Right. Yeah.
Okay.
So that should come. That should come at the end of the financial year.
Yeah. Thank you.
Right. Are there any more questions? It's 10 past, so we've done an hour and 10. I think that's pretty good going for this time of night, and everyone to maintain their sanity. I think it's so. I think that there's been a few things just to sum up. I just want to thank Greg and John for their indulging us and for helping us out tonight. There was Stephen also on the committee, and for everyone else for their participation and interest, and not even had to have a cup of coffee or a cup of tea to keep you awake, or even something stronger. But so thanks very much, everyone. Just to summarize then, we've got the investment committee. We manage the funds on behalf of parishes and also for special funds. We have two different types of funds, with a growth fund and our income fund. And we've gone through the different aspects in terms of what those funds are there for. Hopefully, Greg and John have dispelled some of the myths about investing, but it's a reasonably complex set of parameters and conditions and considerations that we have to think about. So we do that monthly on your behalf, and hopefully that's all been, you've got a little bit of confidence that we are managing those things properly for you. Is that Graham Jones that I see there as well?
He's from Tyree.
Yeah. Graham, how are you? Just saw your sister.
Malcolm.
There.
It's been a long time.
Yes, Graham and I used to work together back in the dim dark days of Bar Beach and St Stewart. It'll be about almost 40 years ago, I think, Graham.
I know it. It's a bit scary, isn't it?
It is a bit scary. I saw his sister the other day too, so It's very nice to see. Anyway, so thanks everyone. It's just a bit of a blast from the past seeing Graham there, and nice to see everyone's still well and keeping warm. So I just finished with the grace. Kia tau, kia tata katoa, te atawha o tō tātou ariki a ihu karaiti me te araha o te atua me te whiwhi na tangitanga ki te wairua tapu. Ake, amene. So